In the previous video, we laid down a template to develop a macro view. A macro view helps us understand the overall direction in which the market is moving and help us prepare for the long-term market outcome. But for the short-term view in the market, we need to develop a positional view. A positional view helps you prepare a plan of action for the immediate trading session. At the end of every trading session, you go back to the drawing room and prepare a plan on how you would approach the market the very next day. Hi, my name is Karthik Rangappa, and in this video, I'll share a template for you to develop a positional view on the markets. As I mentioned in the previous video, this two-part series is to help you develop your own view on the market and not really depend on others for your market analysis. The template that I'll use in this video is one of the many ways in which you can develop a positional view. You can use this template as a starting point, and as you gain more experience in the market, you can develop your own version. When you develop a positional view on the market, you mainly analyze the price-based data. I guess it's best if we do this practically. I will now look at the end-of-day data to sketch out a plan for the next trading day, that is 18th October 2022. When you develop a positional view on the markets, always start with the broader index analysis. You can look at either the Sensex or the Nifty 50. Most F&O traders prefer to analyze Nifty 50, and that's my preference too. As a starting point, I like to look at the exponential moving averages. I prefer to look at both 100 and 200-day exponential moving average on Nifty 50. Now this is an interesting chart. There is a crossover in the 100 and 200-day EMA sometime in August 2022, indicating a bullish momentum in the market, which is still intact. The 100-day EMA is trading higher than the 200-day EMA, and the spread between the two averages is at least 200 points, which is comforting. Notice how the market took support at the 200-day EMA a few sessions back and bounced from those levels. Many traders, including the institutional traders, look at 200-day moving average as a reference point for momentum in the market. So as a starting point, include the 200-day moving average analysis in your positional view template. Today's Nifty close, that is on 17th October 2022, is at 17,311, a price point which is higher than both the 100-day and the 200-day EMA. At this point, I'm already inclined to think of long trades for 18th October, but I'll hold off and look at other data points before making a call. I can extend the moving average analysis and look at the 9 and 21-day EMA to get a perspective of how the short-term averages are behaving. There is a crossover in 9 and 21-day EMA sometime around 23rd September and suggested that there could be a weakness in the market, probably due to profit booking. While the crossover is still intact, today's close is higher than both 9 and 21-day EMA. Looking at all the four averages, I'm now tempted to look at long trades for tomorrow. But as I mentioned earlier, I'll still hold off and look at other data points before concluding that. When you look at the moving averages, also ensure you look at the advanced declines ratio. Ensure that there is a broad-based activity in the market and it's not just the index heavyweight which is moving the index. As of today's close, there are 37 stocks in the index which is moving up and 13 declining. This is a fairly good ratio. Pay attention to what India VIX is doing. I'll soon do a video on VIX and volatility in detail, so you can check that for more details. VIX can give you some good insight into the underlying sentiment in the market. I still remember in March 2020, India VIX had shot up to 85. While all indicators pointed to bearishness, India VIX was hinting at a reversal in markets. As of today, VIX is around 18, which is around its historical average, and you can't really make a decision simply based on VIX. But, like I mentioned earlier, glancing through VIX should be a part of your daily market analysis. Next up is support and resistance. I have a detailed chapter on this topic in Varsity. I would highly encourage you to read through it. A quick check tells me that the broad support for the market is around 16,950 and the resistance is around 17,325. I have seen traders sweat over the exact support and resistance point. But this is useless in my opinion. Support and resistance is a price band rather than a single price point. For example, although I mentioned that the resistance is around 17,325, I would be comfortable in treating the price zone between 17,300 and 17,350 as a resistance zone. For example, although I mentioned that the resistance is at 17,325, I would look at the entire price band between 17,300 and maybe up to 17,350 as a resistance zone. I would expect the bullishness to continue if market sustains today's close price. Another way to develop a view on support and resistance is by looking at the option chain or the open interest data. I've picked the open interest data from Sensible. 17,000 put options has a large open interest buildup, nearly 10 million contracts. And the 17,300 call options has a large open interest buildup, both indicating that the markets are unlikely to break below 17,000. So far, we've looked at the moving averages, both from the long-term and short-term perspective. We've looked at the advanced declines ratio to back our moving average analysis. We've looked at the support resistance, both from the chart perspective and from the options data perspective. We looked at the India VIX numbers as well. Now let's continue our analysis and look at the institutional fund flow. I look at Sensible platform for this data again as they neatly organize this information. We can see more activity in put options on a cumulative basis. The net put is around 3 lakhs, nearly 50% higher than the call options. In the overall scheme of things, this is a contradicting data point. While everything that we've done so far is indicating bullishness, this particular piece of data is indicating bearishness. Situations like this is where your experience as a market trader kicks in. While every indicator points to bullishness, why are institutions still holding on to puts? You will have to figure whether the institutions are building their put positions or are they reducing the put positions. Let's take a quick look at the put positions on 14th October, that's the previous trading session. The net put position on 14th October is around 3.26 lakhs. So clearly the institutions are reducing their put position. This is in line with the overall analysis that we've done so far, and now even this points to a bullish outcome. While we've looked at the FII data on a cumulative basis, let's see what the FIIs have done today, that is 17th October 2022. Every data point here indicates bullishness. By the way, if you're unsure of how to use these data points, I would suggest you go to Sensible's YouTube channel and look for videos. My friend Abid has put up some amazing content explaining how you can use these data points. One last data point to check: the chart patterns. I'm not sure if I can categorize the last few candles into any recognizable candlestick pattern, and that's absolutely okay. It is not always necessary to find a recognizable candlestick pattern. You just have to get the price action right. I've done a video on how to use the candlestick patterns the correct way. I would suggest you watch through that once. Going by the price action, I would look at today's candle as a bullish pattern. There was an attempt to bridge the gap up opening of 14th October, which was firmly rejected by the bulls. All the intraday decline of 14th was recovered today, suggesting that the momentum is likely to continue. So combining everything so far, that is the moving averages, advanced declines, wicks, support and resistance, option chain, FII data, and the chart patterns, I'm convinced to set up a long trade for tomorrow, that is 18th October. So here is my action plan. Every data point indicates bullishness. If not for going long, I'll certainly avoid short trades for tomorrow. Figuring out what not to do in the markets is as important as figuring out what to do in the markets. If I'm trading Nifty, then based on my capital, I'll either consider 17,000 or 17,300 as a stop loss for my long trade. If I'm trading stocks, I'll only set up long trades and avoid short trades as the broader market supports outcomes for a long trade. For stock-specific trades, I'll also look at stock-specific charts and also the sector-specific chart. For example, if I'm trading HUL, then apart from looking at the HUL chart, I'll also look at the Nifty FMCG chart to ensure that both the charts align to similar outcomes. For stocks, along with everything else, I would also look at the volume data. I have a detailed chapter on how to use volumes in Varsity. I would suggest you give it a quick read. If I'm trading options, I'll always prefer a spread position as opposed to a naked long or a short. For example, if I was to set up an options trade for 18th, I would probably look at a bull call spread as an option. I would even be comfortable with a long futures trade for 18th October. Two last things before I conclude this video. When you strategize a trading plan, ensure that there are no fundamentally driven events on that particular day. For example, RBI monetary policy or a press conference by the finance minister. If there is a fundamentally driven event, then keep all your positional view aside until the event unfolds. Do not be in a hurry to punch in a trade right at the market open. As a thumb rule, always pay more attention to fundamental data as opposed to price-based data. If you're trading stocks, pay attention to corporate announcements or quarterly results announcement in the stocks that you prefer to trade. Wait for these events to unfold and then position yourself in the market. Second, do not trade based on just one or two data points. Combine multiple data points and ensure a majority of these data points point to a similar outcome. This is when the probability of a winning trade is higher. As I mentioned earlier in this video, this is only a template for you to get started with your own independent market analysis. And with that, I hope you become self-reliant in the market. I'll see you guys in the next video.